Joining us now to analyze the great commodity collapse is Robin Barr. He is analyst at Societe Generale. He's joining us from London right now, and also joining us in a moment is Mathur, Associate Director, Commodity and Currency at Angel Broking. He joins us from here in Mumbai. Let me come to you first, Robin. As far as the entire jitter goes, when it comes to the commodity markets, do you think it's more to do with the possibility of a Fed rate hike, that it could happen before the year end, or are there more reasons that we could ascribe to it?
The headwinds coming from a stronger dollar because of the probability of a Fed rate hike is playing a part, but we would argue the biggest driver remains supply and demand, and notably oversupply and a lack of production cutbacks to address the oversupply at a time when there are concerns of slowing economic growth, particularly in China, which is feeding through into weakening demand. And in fact, it looks as if the demand side is very weak, particularly right now, which should be a fairly robust period with a pickup in physical demand. We're not seeing that, and therefore the market is concerned that this oversupply will continue to maintain downward pressure on prices.
Right, so supply glut, now that's one of the reasons. Naveen, I want to get you in on this. How severely do you expect this commodity rout that we are seeing to play out on the equity markets? Of course, globally is one picture, but merely perhaps as a, and not merely as a consequence really, why would we see this kind of impact the Indian equity markets as well? How do you think that's going to play out?
I think the overall commodity space looks bearish, as Robin is also talking about.
Yes.
Particularly if you're asking me for the overall pack on commodities, we are definitely negative on the commodities right now. The demand factor, the supply factor, everything is not conducive for the prices to move up on the trajectory. So overall fundamental factors plus the currency factor, which is strengthening of the dollar, and expected Fed rate hike in this December FOMC meeting, are all the factors which are pressurizing the prices on the downside for the commodities. Be it crude, be it gold, be it base metals, everything is in a problem. The Chinese economy is in a problem, and therefore the base metal pack itself also is not doing not doing well.
Right, so there are questions getting raised, Robin, whether this is to do, and that's the sum and substance really of what I was asking you rather initially, whether we're looking at an economic collapse, because this 20% kind of hit that we're seeing on the commodities front is the same number that we saw in the year 2008. Are we looking at the possibility of a larger economic collapse right now, like some people are suggesting?
There's always a possibility. You're correct in thinking that commodity prices, particularly copper, are a good indicator of economic growth, or not, as the case may be. And the fact that copper prices and other base metals have fallen so sharply is obviously impacting on sentiment, and there are fears that global growth could be a lot weaker than a lot of private forecasters and some of the multilateral agencies like the OECD, the World Bank and the IMF have been forecasting, which is about 3% GDP for 2016. There is always the risk that growth could come in much lower than expected, particularly if China, the economy as a whole, endures a hard landing. Now, we've seen a hard landing in the secondary sector of the Chinese economy, which is industry and construction. The financial part, services part of the economy is still growing. However, that could change quite quickly. So probabilities of a hard landing by many are seen as increasing. It's not our base case at Societe Generale. We still feel that GDP growth next year will come in at around about 3% level, but obviously the probability is rising all the time of a feared hard landing in China.
A hard landing in China, and perhaps those fears are getting reflected in the pressures that we're seeing in the commodities space. Of course, Robin, oil seems to be the most striking example of economic collapse from the commodities space, and why not? It is possibly the most economically sensitive commodity in the world. In fact, gold too has seen a considerable fall. How much pain are you expecting on these two commodities going ahead from here in the backdrop of its interplay with the US dollar?
The first rate increase in almost 10 years by the Fed, we believe, is going to be the first of a number of tightening moves in 2016 and into 2017. So tightening monetary policy will underpin the dollar, will underpin rising bond yields, and this could be a headwind that commodities will run into, most specifically for gold, which is very sensitive to monetary policy in the US. The other industrial metals perhaps should take some encouragement that the US economy at least is growing robustly, and therefore the government is, or the central bank is wanting to tighten policy. Certainly for gold, though, and to some extent silver, rate increases, we believe, are very bearish for that sector.
Naveen, do you agree with that view that the US economy is looking robust right now? Would you think the Fed is going to consider this rout that we're seeing in the commodities space when they consider that liftoff or not, as minuscule as that may be? But do you think that's going to play on their minds?
Yeah, that's right, very much. I think the U.S. economy is pretty robust. Minus the U.S. economy, the rest of the world is not faring well, let it be the Eurozone or the China economy or the emerging markets. So the bright spot is only and only the U.S. economy. And I think with the employment data, with the data coming, the economic indicators which are coming from the U.S. are quite positive. They are not worried on inflation right now, I think, but they are worried upon how the asset pricing is happening. And I think many voices are talking about today for a probable rate hike, and I think 25 basis points would be something which the Fed may consider this time, although the rate hikes would be moderate, and they won't be pretty high. I mean, the slope of the trajectory of the rate hike would be pretty moderate, and they won't go for a steep hike in the rates coming years. But I think all said and done, the currency would appreciate, and because of the currency factor and particularly the dollar appreciation, we may continue to see the downward pressure building on the commodities prices.
All right, Naveen, and very quickly, what then is your advice going to be for those who trade in commodities, keeping in mind this looming threat of a further collapse? Which commodities do you see the maximum pain, and how would you deal with those commodities henceforth?
I think the trading on the commodities differ from a person to person and the kind of a profile of one investor or the trader has. But I think the overall the decline would be not so steep, although the dollar would appreciate, but I don't think so. The commodities have discounted these kind of currency factors in the last 2 years. People are expecting the prices to go down, and they are. I think in India or the international market, somewhere the gold would stabilize at around $950 to $1,000, and Indian markets we see around 24 to 24.5. For crude, again, $40 or $35 would be something where the prices would be, and I think the Brent and the WTI may consolidate. It's not a question of the prices may consolidate around $40 levels, but I think it's more to do with supply, the oversupply in crude oil markets rather than demand. So I think the prices remain bearish, but a lot of the news of the Fed hike has already been discounted, and so we may not see too much of a downslide from here.
Right, not on the back of the possibility of a Fed rate hike, but perhaps the other global pressures that Robin is pointing out as well. That's going to weigh on the commodity space, and we'll have to see how it pans out from here. But right now, we're seeing that kind of pressure really build up. Thanks indeed, Robin and Naveen, for sharing your perspectives with us. We'll take a quick break. After that, the GST rate debate, that continues. Chief Economic Advisor Arvind Subramanian meeting Arun Jaitley and the Revenue Secretary Asmukh Adhia to discuss all of it. We'll talk about it in a moment.